Thank you, Grant, and thank you, Davidson Company, for this opportunity. Jeremy and I were just chatting about how this is a really good opportunity for us to engage with stakeholders. It's nice to see a full room, so thank you for organizing. And I have to congratulate Davidson Company. They've added the word annual to the heading of our event today, so I think we're going to be doing this in the future probably. So I have prepared several topics. They're all pretty related. I'm going to talk about the findings from our continuous disclosure reviews in the past fiscal year. I will touch on some processes and requirements as they relate to restatements and refilings. I did talk about that last year, so I'm going to deal with that topic quite briefly. Then I'm going to spend some time focusing on non-GAAP measures. This is an area we have focused on in our reviews. We are continuing to focus on, and we're actually thinking of doing a little more work in terms of looking at the current guidance we have and thinking about whether it's enough and whether we should expand on that. I'll touch briefly on the quarterly highlights option for management discussion and analysis purposes. That's an option available to venture issuers. And then I'm going to close off talking about our disclosure standards in terms of the general requirement that flows from the Act and then the Securities Act, and then how that's reflected in some of our policies and requirements that pertain to financial disclosure. And I think that'll kind of tie together some of the other topics that I've discussed today. So let's launch in. The Canadian Securities Administrators, we summarize the results from our continuous disclosure reviews each year in a staff notice. We do it with the March year end, and I'll be highlighting the results for the year March 2016, but the reviews that we've been doing since then are very similar in terms of the nature of the reviews and the findings. We do our reviews of issuers' continuous disclosure to help issuers comply with the securities legislative requirements and to help them improve the quality of their disclosure. We do what we call full reviews, where we are looking at all the required filings over the past year, as well as issuers' press releases and their websites. And then we do issue-oriented reviews, where we focus on specific financial statement items or specific form requirements. We did 280 full reviews and 622 issue-oriented reviews across the country, and those numbers are similar to what we did last year. So for the issue-oriented reviews, this slide lists the key topics that we looked at. We looked at financial statement issues, MDNA, non-GAAP measures, press releases, material contracts, and their requirements around those. And then about a third of our issue-oriented reviews were on mining, technical, and oil and gas disclosure. The outcomes for this past year were similar to the prior year. In about 8% of the cases, we referred the item to our enforcement department, or we put the issuer on the default list, or we actually directly cease traded the issuer. In 23% of the cases, the issuer had to amend and refile a document. That's one or more documents. In 31% of the cases, the issuer agreed to make a prospective change, so that's in their next filing. And that category also includes where the issuer agreed to restate comparatives in the next filing, so comparatives to the financial statements. So that subcategory of prospectus changes is actually a little more similar to the refilings, and probably in future years we're going to split that out. So thinking about the financial statements, what were some of the recurring problems that we found here? The first was in the area of accounting for business combinations and intangible assets. One of the problems is that issuers sometimes don't appropriately identify the existence of intangible assets in the financial statements. So there's the allocation to the tangible assets and liabilities with the balance going to goodwill, but when we look at the MD&A, there's discussion strongly suggesting the existence of intangibles like in-process R&D, favorable lease terms, customer list, those kinds of things. Another category of challenges around intangibles is maybe the issuers correctly identified the existence of an intangible but inappropriately assumes indefinite life when the facts and circumstances suggest otherwise. So IAS 38 has some important comments on determining the useful life of intangibles. One of the comments is about computer software and the susceptibility to technological obsolescence. Another is that just because there's a contractual term that is indefinite, that may not line up with useful life. So I encourage you to consider that. A second area of recurring problems relates to contingent consideration. So some issuers failed to correctly identify and record the consideration, and as well, some failed to properly account for changes in fair value. So IFRS 3 talks about fair value changes that may occur during the measurement period that qualify to be treated as a change in the price, but other changes in fair value, maybe meeting an earnings target or reaching a specified share price, it does not qualify to be treated as a measurement period adjustment, and so we saw some problems in that area. A third area that we found some challenges in this past year relates to functional currency. So the issue was a change, and we found a number of instances where a change had been made, but the facts and circumstances did not seem to warrant it. So the standard says that once you determine the functional currency, that doesn't get changed unless there is this change in underlying events and conditions. So the other thing to remember is if the change is appropriate, then it's done prospectively, and there has to be disclosure about those underlying transactions, events, and conditions. A fourth area is segment disclosure. So what we find sometimes is an inappropriate aggregation of segments, and the standard is very clear about the need for similarities between the products as the surfaces, the processes, the environmental issues, and so forth to qualify for aggregation. And we look to how the issuer is describing its business in its MD&A and other locations, and what we have found is sometimes that strongly suggests there are segments, and yet everything's aggregated in the note to the statements. So we challenge some of that treatment. In terms of financial instruments, there were some areas where we didn't see full compliance with the disclosure requirements relating to currency risk, interest rate risk, and other price risk, as well as credit risk, and particularly on the credit risk where financial assets are past due or impaired, the requirement to provide disclosure about the aging, the factors to consider that were considered in terms of assessing impairment, and collateral obtained. So those are the financial statement items that I'll highlight from our reviews. In terms of MD&A issues, this slide lists a number of topics we focused on and found recurring deficiencies. I'm just going to refer to the first couple. A number of issuers facing going concern challenges and liquidity risk didn't do a great job talking about the situation in their management discussion and analysis document. The point is not to just cut and paste from your financial statement note. The purpose of the MD&A is to amplify, discuss, talk about, what are the plans to cure the problems, deal with things like defaults in covenants and those kind of issues. A second area I want to highlight is forward-looking information. So, of course, a lot of issuers do disclose forward-looking information in their news releases, sometimes in their MDNA. And the problem that we see is a failure to update. So our continuous disclosure rule requires that if you do disclose forward-looking information, then you have to update it. You have to talk about the events and circumstances that are likely to cause actual results to be different from what you previously disclosed. And also, if you decide to withdraw forward-looking information that you previously filed, you have to disclose that fact and explain the reasons why. I'm just going to leave the other topics there. You can look at the notice that it was cited on the first slide there for details. We also looked at a number of other requirements. And again, I'm just going to highlight a couple here. In terms of material contracts, our rules prohibit redactions of a number of aspects, including debt covenants, the ratios in financing and credit arrangements, and there's a provision you can't redact terms that are necessary to understand the impact of the contract on the issuer's business. And while there's some judgment involved, when we see heavily redacted material contracts, we will challenge that. The second bullet here refers to the audit composition of venture issuers, and just a reminder that starting Jan 1st, 2016, the requirement for venture issuers is that the Audit Committee has to be composed of a minimum of 3 members, each a director, and the majority not executive officers, employees, or control persons of the issuer or affiliate. And really that lines up with exchange requirements, so haven't seen for the most part any substantive changes there, but we did see some non-compliance with that, so wanted to highlight that change. So that's it for my comments on CSA results, the Canadian Securities Administrators. But I also wanted to just mention a review that BC staff did this past year. And we decided to focus on one aspect of auditor independence. We chose this because we had stumbled across this issue with a couple previous files. So just to give context, the Code of Professional Conduct requires an auditor to be independent and remain free from influence, interest, or relationship which impairs judgment or objectivity in the view of a reasonable observer. And there's guidance that talks about overdue audit fees and how that can create a self-interest threat to independence, similar to a loan outstanding, especially if that amount remains outstanding when the next year's audit report is being issued. And there's discussion in the guidance about safeguards that might reduce this threat to independence, things like talking about the situation with the Audit Committee, having a professional colleague who's not a member of the firm to come in and review the work. The guidance doesn't go as far as being really clear about when certain safeguards will work in certain contexts, and in particular in relation to the amounts and the terms. So we decided to take a look at this. What we did was we selected clients from 24 BC-based audit firms. We picked our sample by identifying issuers that appeared to have capital deficiencies, and we picked at least one client from every firm, equal opportunity here. And what we did was we looked at the amount, nature, and time that the fee had been outstanding, and we did refer a few situations to CPA BC. At the end of our review, we've concluded that outstanding fees may pose a risk to auditor independence in a relatively small segment of the BC market, and we will continue to monitor this area. And I think the takeaway message is we're encouraging issuers and auditors to avoid this threat to auditor independence. So, topic number 2, and don't worry, Grant, I'll get faster. So we chatted a little bit about this last year, and I like to review this because when it's time to make a correction, it's important to know what the requirements are. And of course, there's little stress involved when it comes up. So good to review this in advance. And of course, it relates to what we've just been talking about, because one of the outcomes from our reviews is the identification of an error or significant omission. Of course, there are circumstances where an issuer on its own initiates an amendment. And just a side note, we do monitor and take a look at any instances where comparatives to financial statements have been restated. So there are two approaches for addressing a misstatement in financial statements or another continuous disclosure document. The first is to amend and refile the document, and the second is to restate information for comparative periods. Usually that applies only to financial statements, also to some elements of MDNA. And there's two factors that you have to look at to figure out which of those two approaches is going to be appropriate. First is the pervasiveness of the error. You think about the extent to which it's confined to specific elements, accounts, or items in the financial statements, whether it relates to a substantive portion of the financial statements, and if it has to do with disclosure, the question of whether it's fundamental to a user's understanding of the statements. Timing can also be a factor, but really we don't think timing is a factor for interims. It comes up with annuals when there's been a significant lapse in time between when the audit report was issued and when the problem is discovered. An issuer should assess these factors by talking with their audit committee, the auditor, and legal counsel. And in the case of material correction, we suggest to consult with BCSC staff. And this is probably the most important slide here on this topic, which is that if the new information is going to differ materially from what was originally filed, our rules require the issuer to put out a news release immediately upon making the determination that that's going to be the case. So you might not have all the numbers figured out, you might not have a new filing ready, but once you know that the information is going to differ materially, then the press release is required. And so, of course, the key is it going to differ materially? What do we mean by materially? Well, we've got our standard on Disclosure Standards 51-201 that has a big section discussing materiality. You can also look to the guidance on materiality in our accounting standards. There's specific elements within IFRS, as well as the conceptual framework. Also, the guidance on materiality in the auditing standards may be helpful. And so if there is an error, just a reminder, you've got to think about the impact on the Auditors Report, MDNA, and the certificates. And this last slide just gives an example. And the key there is an emphasis of matter paragraph in the Auditor's Report highlighting the note to the statements that explains the situation. So enough on restatements, right? Okay, we're going to talk about non-GAAP financial measures. No doubt you've seen more coverage on this topic in the media this past year than ever before. And the reason is everybody's thinking about this, doing reviews, issuing new guidance. I'll talk about what we're doing in a moment, but just to comment briefly, the FCC in May of 2016 updated their interpretive guidance relating to their rules. They addressed some specific practices that they were concerned about, and following that issued numerous comment letters, and we've seen coverage of that in the media. In Europe, the European Securities and Market Authority published guidance in early 2015, effective July 2016. promoting the usefulness and transparency of alternative performance measures. That guidance is quite similar to what we've got in Canada, our staff notice. They don't have explicit requirements or prohibitions relating to the measures, so they don't stipulate which ones you can use, which ones you can't, but there's disclosure principles to follow. In the UK in November 2016, they did a thematic review of alternate performance measures based on the ESMA guidance. And the International Organization of Securities Commissions published a statement of non-GAAP measures in early 2016. That material was very similar to the guidance in our notice. We've also seen the International Accounting Standards Board talk more about issues that come under this umbrella of non-GAAP financial measures. A discussion around whether there should be more subtotals specified in the statement of operations, whether we need a principle-based definition of operating income. Don't have that, right? So, of course, that measure, operating income, comes into a lot of these non-GAAP measures, and do we need to define it explicitly so that there's more consistency with how the measures are calculated? Other measures like earnings before interest and taxes, should there be an explicit definition in the accounting standards? So I think we'll see more discussion from the International Board on this. So let's just think a little bit about where we're at in Canada with our notice. We did make a few changes early in 2016. This slide highlights those. We retracted the guidance we had on subtotals, and we did that because of the new material that became effective in IS1, so we didn't need that material in our notice. We also tweaked our definition of non-GAAP measure. It is a numerical measure of historical or future performance, financial position, or cash flow that is not specified, defined, or determined under the issuer's GAAP, and is not presented in the financial statements. And we also added a little bit of commentary about certain performance measures that are not non-GAAP measures. So we clarified that if a measure is calculated without using a financial measure, or a measure is calculated partly by using a measure that's in the financials, that measure is not a non-GAAP measure. But if you have a measure that part is using a component that's a non-GAAP measure, then the entire measure falls within the scope of our guidance, and the non-GAAP measure component should have the disclosure elements discussed in our notice. So an example of that would be adjusted comparable sales per square foot. So what we did not change when we made these amendments were sort of the core elements of our notice, which is to talk, there's about 7 practices that talk about the disclosure that should accompany a non-GAAP measure to help ensure that it's not misleading. And we've talked about that before. I'm not going to go through all that. You know, it's about warnings, cautions, giving the reconciliations, the naming, that kind of thing. So just thinking, this slide I borrowed from a presentation earlier this week. It's a webinar that I believe CPA Canada is making available. My colleagues from the Ontario Securities Commission put together that presentation, and this presents some of our largest issuers in Canada and kind of compares their the center column there displaying the net income per the financial statements, and then on the far side the non-GAAP measure that they emphasize in their materials, and you can just see the very significant differences there. So of course this is why we're talking about it, like how, you know, what are the appropriate things to adjust for? How are these measures useful? And is it fair to characterize certain adjustments as rare or one-time unusual? Those kinds of issues. In terms of our continuous disclosure reviews, the kinds of things that we're asking about and challenging, some of those are highlighted on this slide. We ask about situations where the non-GAAP measure gets a lot more emphasis and prominence than the GAAP measures. We are asking issuers about inconsistencies over time in the way they use the measure, asking them to explain changes when those are appropriate. And we're particularly concerned about the clarity of the reconciliation of that non-GAAP measure to the numbers in the financial statement. So they should be clearly laid out. You should be able to tie the numbers in. There's usually a reconciliation, but understanding it is often a challenge. And then another problem is that certain measures are presented and not appropriately identified as non-GAAP measures, so we're certainly asking about those. And just wrapping up this topic, if an issuer does use non-GAAP measures, we think it's appropriate for the Audit Committee to be talking with management about those measures in the context of their review of the financial statements and MDNA and earnings releases. It's a great opportunity to ask about, what measures make sense? What changes to those measures make sense? What are the policies around changing them and disclosing them? And we think our notice provides some good guidance to help that discussion. Okay, if you're a small venture issuer and you don't do non-GAAP measures, we're done with that topic, and here's something for you. So I wanted to put a plug in for quarterly highlights. This past year, we had about 80 BC-based venture issuers that used this new form of MDNA. This is a form available for Q1, 2, and 3. There were about 200 across CSA, and frankly, we'd like to see more venture issuers take the opportunity to use this more streamlined form. So what I can tell you is that we did not put any reporting issuers on the default list or cease trade them as a result of not meeting the requirements in this new form. The goals, of course, as I mentioned, is to get away from the more lengthy one, to streamline the information, to get away from boilerplate. This is an opportunity to do a more concise, targeted disclosure of what happened in the interim period. There aren't any restrictions about switching between our long form of MDNA and the quarterly highlights version, but we do encourage a venture issuer to continue using this quarterly highlights if it starts on that. In terms of filing, it's in the same filing category in CEDAR, so nothing new to figure out from that end. And this slide lists the 6 core areas that a quarterly highlights needs to address. And it's pretty basic. I'll let you read that for yourself. But some people have asked us, well, can you give us examples? We hate to give, ideal examples because it is very fact specific, but what I can say is we've seen some very good ones that are 2 pages. So it can be quite short depending on what's going on with your entity. And we're going to do a bit of a review, pick a sample, and probably put out a staff notice commenting on what we've seen and give some suggestions going forward. So if you're interested in that, please stay tuned for that publication. How am I doing on time? How fast do I have to talk for the last bit? We're going to close off by, as I mentioned, just kind of thinking a little bit about our general requirement. Comes from the Securities Act, Section 168. And basically that section prohibits a person from making a statement or providing information in any record required by the Act that is false or misleading, or omitting facts from a statement or information necessary to make the information or statement not false or misleading. So how is this principle reflected in some of the rules we've been talking about? We chatted briefly about forward-looking information. that has to be that has to have a reasonable basis and have the appropriate accompanying disclosure. I won't get into the disclosure requirements. You can look that up. It's in 51-102. And of course, there's specifics for the subcategories of future-oriented financial information and financial outlooks. And the emphasis is reasonable assumptions. I mentioned earlier our disclosure standards policy. And this is a policy that talks about practices to avoid selective disclosure. And it also deals with how you come up with a disclosure policy. And one of the components I want to highlight, because I think sometimes, financial officers and others maybe aren't aware as much of this policy, but one of the really helpful portions of this policy talks about how to use electronic media and corporate websites, and what the policy should be for board and audit committee review of disclosures in advance of public release. And so, for example, in the area of electronic communication, it talks about having people responsible for your website to update material, move outdated stuff into archives, data everything. If you, when you file things on CEDAR, make it available on your website. If you give additional information to certain investors, put that on your website. It also cautions that putting material on your website doesn't satisfy your legal requirement to generally disclose information. And so there's discussion around those topics. If you haven't taken a look at that before, take a look. This slide's a reminder of what 52-109 has on the topic of misleading. And of course, officers, when they're certifying, these are the statements that are there. Do not contain an untrue statement of material fact. Do not omit or state a material fact. Just a reminder there. And then, of course, audit committees have to review the filings and be satisfied that there's procedures in place for the review of public disclosure of information extracted or derived from the financial statements. So here's a little example. Erez and I were talking about the challenges around use of social media and how does that fit in with an entity's continuous disclosure. So here's an example, and we've had a number of these situations where an issuer's website links to material that a third party has produced. But when that link is on the issuer's website, we consider that part of the issuer's disclosure. And so in this example, very promotional language. There was also a lot of forward-looking information in terms of promises for dividends, increases in KPIs, and so we were concerned about the lack of the disclosure accompanying the forward-looking information that's required by our rules. We asked about the assumptions and those kinds of things. In this example, the material was actually removed. The links were removed from the issuer's website. So just a kind of a little example of a caution of the reality that your website is part of your overall continuous disclosure record, and we do consider it when we do our reviews, and we look at how the material on that relates to your required filings. And I'm sure I've gone way over my time. I apologize.
Yeah, okay.
But thank you very much for your attention, and we're going to take questions later.